Hello and welcome to the business interview here on France 24. I'm Marcus Carlson. Big Ben has spoken. Federal Reserve Chairman Ben Bernanke says the U.S. economy is still bleeding after the financial crisis. He spoke at Jackson Hole in the U.S. state of Wyoming during a forum that brings together the world's top central bankers. Markets were looking for clues whether or not Bernanke is willing to take action to prop up the American economy. To help us decipher what was said, let's turn now to our guest, Valérie Plagnol. She's chief economist here in France for Credit Suisse Private Banking. Welcome, Valérie.
Hello.
Let's start with this. If we were to summarize what Ben Bernanke said, I suppose he stopped short of announcing more quantitative easing or more measures to stimulate the US economy, but he said there were still tools in the toolbox, so to speak. What do you say about that?
Well, I would say first that he said the economy was healing, not only bleeding at this stage, but it's also a very weak recovery, and he conceded that much. And numbers sustain that assertion. And it's true, he has come short of explaining what are the tools in the toolbox, although he has indeed confirmed that there are still some of those tools available for the Fed to intervene. I think in the course of the week, the market had raised their expectation very high at the beginning of the week. And as the week went on, it was clear to more and more in the market that little would come out in terms of really action plan. Mm-hmm. We would have no detail of such a kind today. So I think the appointment was limited in this respect.
Ben Bernanke, as you pointed out, he said that the U.S. economy is still suffering after the financial crisis. Unemployment, for instance, is still quite high, or very high indeed. But he was more optimistic in the long term that the U.S. economy will actually be boosted in the long term. That was his main argument, it seemed like. What do you say about that? Do you have the same hopes as Ben Bernanke has?
Well, that is a very important point because, of course, this was the central theme of this particular meeting in Jackson Hole this year, how to assess the future. And after such a massive crisis, everybody has been looking of the fall and the gap that has been open in terms of the growth in the U.S. economy and everywhere else, and how much that gap can be closed in the long term thanks to much more structural tools and capacity of the U.S. to recover on a very long-term sustainable path of growth, which implies also what we call potential growth. Mm-hmm. And that means an optimal combination of using capital investment, educations, and raising the level of education. I mean, he has hinted at several issues and structural issues that, of course, are not in the hands of the Fed as such, but that need to be raised in the long term to maintain this kind of potential that the U.S., he believes, has through high level of education, entrepreneurial capacities, and a very flexible labor force. And these are indeed qualities that we know the U.S. has and is indeed still the biggest economy in the world.
It seems as if you, just as Ben Bernanke, you're fairly optimistic that the U.S. perhaps will take a step away from the brink of recession. Would you say that that's the case?
That's actually, at this point, that's our scenario. Now, we're talking very much shorter-term issues, but it's true that, just as anybody else, we had to assess and reassess our forecast recently with regard to the revisions of the first half of growth that was really down compared to what was initially announced. Nevertheless, we believe that the capacity for the U.S. economy to be more resilient in this very soft patch is somehow sufficient to drive them through this moment in this rather difficult second half of the year.
So you use the word soft patch and not recession at this stage. That's key, isn't it?
It is very important because it really changes also our assessment with regard to our view on the market. I mean, we've just had a major panic in the market. I think we can call it that.
It has been very tumultuous in the past few weeks. What's going to happen in the coming week and the week after that? What's your view?
Of course, it's very difficult to say when you still have very high level of volatility into the market and there's been a lot of losses out there. Nevertheless, I mean, our view at this point is that the market has been somehow oversold and overreacting to the risk of, again, a double dip that we don't have in our scenario.
Now, one thing that's been brought up in the past few weeks is the risk that perhaps the United States, as well as the eurozone as well, are becoming another Japan, where growth in the past decades even has slowed to a standstill. It's stagnated. Do you think we could be looking at that kind of a risk in the longer term, that in 10 years' time we'll have little to no growth in the United States as well as in the eurozone?
I think this is definitely a challenge that everybody has in mind. We would be foolish to ignore that. And what was called the lost decade, if not the lost decades, is indeed something that even the central bankers, and including Mr. Bernanke, has expressed even out saying that the risk is that we come into a deflationary period out of which we just accumulate ever-growing debt without coming to a stronger growth. That is a risk. That is a risk the central bank is ready to address and has tools for that, meaning making sure that those inflationary anticipation doesn't fall back into deflationary anticipation. And you remember what was said just this time last year about Bernanke's decision to inflate in a way the economy. That's really something. The second point is that also central bankers turn to politicians, and saying, well, reducing the level of debt while we help is crucial, because as you know, so Japan has only increased its debt burden to a point of being quite unbearable and really crowding out private investment and initiatives. So all this combined means there are solutions, there are ways out of that, but they need to be applied now.
Now, what do you think the chances are that they will see quantitative easing in the short term, in the next few months, when the FOMC meets in September, seeing what you've just said, the fear that the United States and the eurozone will become another Japan?
Well, I think in the short run, the Fed is really holding its gun, if I may put it this way. They are indeed waiting to assess properly not only the economic situation, but also the political scene. And there are also issues at stake right now, because when the Congress reconvene, there will be a bipartisan meeting which should conclude, hopefully, on an agreement to reduce spendings further for the next 10 years. And that's also key for the Federal Reserve to assess what they can do on top of that. And
so the Federal Reserve is watching Capitol Hill just as much as Capitol Hill is watching the Federal Reserve.
Yes, because they need to assess how much fiscal tightening will be applied to the U.S. economy and when. And that's also key for sort of rebalancing the effort with regard to what the Fed can do. Now, the second part is, of course, the Fed will be giving itself time to assess the economic data. Actually, since the last FOMC, we haven't had so many new economic data at hand to really assess what is going on. And that's also key. Employment numbers will be, of course, very closely watched. These are very important numbers for the Fed to decide when it is the best moment to act.
Now, I want to return a little bit to the market turmoil that we spoke about a little bit before. 6 months ago, it seemed as if a lot of people were saying that the recovery would actually speed up towards the latter half of 2011, that it would get better throughout the year. Instead, it seems as if it's just getting worse and worse the longer we get into 2011. What happened?
It's true. It's been quite a reversal, and the first part of the year, the first quarter of the year, showed quite strong numbers in the first issuance of those numbers in the US and in Europe, and we were looking at a much stronger and sustained economic growth. Many things happened at the time. Let's look into this. You saw oil prices went up much higher than we expected. The Japan earthquake and Fukushima was a major interruption into the production chains, and that probably will be restored partially coming into the third quarter. So I'm still expecting some better news there in some corners of the economic activity due to this, imbalance and corrections of the production cycle. And we've seen also that emerging market, a major engine behind the recovery in the past 2 years, have had also their own problems faced with inflation. They have started and they have initiated a soft landing of their own economies. All these combined came to a softer pace of growth. Now, the problems when you get to this quite difficult moment, then if you get an extra risk, which sort of came up with the risk of having extra fiscal tightening, extra credit tightening, and that was the fear of the market in the months of August throughout the numbers, statements, prices that we saw, sort of pushed the market down into looking at a much weaker second half of this year.
We don't have a lot of time left, but just one quick question on the eurozone and its health. You said that the US economy is going through a soft patch. Is it a similar story for the eurozone economy, or is it a recession on this side?
Well, indeed, the eurozone is going through a soft patch as such, and the numbers prove so. Then we have to look country by country, and it is clear at this point that some countries have to make a much tougher effort with regard to their fiscal tightening policies. One of them being our neighbor Italy, for example, and there will be an extra effort asked to some countries, not only Greece, and that also will weigh on the overall growth. But we're still looking at a very soft patch here again too.
A very, very soft patch, but not a recession just yet. Thanks very much, Valérie Plagnol from Credit Suisse Private Banking. And with that, we're going to wrap up the program. Thanks for watching.